Okay, I believe we are live.
Good morning, everyone.
Good morning, Julie.
Good morning, Robert.
This is our easing into this one because if you attended last week, you got to experience the first 10 minutes of audio screeching and feedback because our production studios here in two undisclosed locations did not have their acts together, but we did try this morning to sort of surface all that and figure it out. So hopefully everybody can hear okay, everybody can see okay, and we thank you for spending some time with us.
Yeah, really appreciate it. And how are you this morning, Robert?
I'm good. I'm good. It's day, I don't know, 60,000 of this. My oldest daughter told me she'd been out of school 2 days ago for 65 days is when they let schools go here in Bend. So just kind of working through it. It's strange because there's so much that's sort of clipping along and there's a normalcy here. And then there's a lot of things that are very not normal. Right. And that's in various layers from how we're interacting with each other as human beings to business prospects, to the public health piece of this, to the economy, to unemployment. Clearly a big desire to emerge and reopen, states beginning to do that, Oregon, entering phase one on a county by county basis. So scientists and data-driven folks making good decisions, and then around the fringes here, emotion and opportunism and grievance. So, I don't know. How's that for a big cocktail of an answer?
Yeah, that's a great answer. We're going to try and stump each other with questions. So my first question to try and stump you is, how are you today?
I know, right? How was I? Was that succinct?
That was excellent. Excellent.
Yeah. How's everybody that's joined us today? Is everybody doing okay? Making it through this?
Comments in the chat, please feel free. And there's a place also to ask questions down at the bottom. And someone has asked the first question, which is, have you ever seen a spreadsheet projection that turned out to be true? But I think you had a question.
I will answer that. But before we do that, one, I want to thank everybody for coming. Two, this is the third installment of 6 of these that we were trying to do out of the gate weekly. We're going to kind of take a temperature and see if they're interesting. Maybe we don't do them weekly after the 6th one, or we do whatever. But this is all about you all and your questions, and hopefully our ability either to answer them, not answer them, or point you a direction that may be helpful. So not legal advice, not tax advice, not a solicitation to invest in a fund. I don't know. Did I hit all the disclaimers, Julie?
Yeah, just it's our opinion from our experiences and things that we've seen. And if it's useful to you, great. And if it's not, discard. And we're really happy to have the chance to do this. And just everybody's got a lot going on right now. So we want to make it useful to you. Someone just asked me what my trucker hat is. I was going to wear my mask, but I didn't. I decided I didn't need to this morning. If we have a break, I'll go get it, Mitch. Thanks.
So let me address the question, or try to address the question on spreadsheet projections. And if you've tuned in on previous episodes or seen me somewhere else, I have this saying of now's the time for spreadsheets, not PowerPoint, to try to get into the math, especially around the current situation. And that has to do with the forecast for your business and the plan for your business and what you think in terms of customer acquisition, what you think in terms of customer churn, your own spend model in terms of payroll and some of the other things you're doing. So I think that's kind of the starting point on this. I think that there's this, I guess one angle of this is that you have to have a hockey stick. If you're going to go try to raise money, you got to show people you're going to grow at this ridiculous pace. And so things that are that I think are really suspect. I think I'll speak for you as well, Julie. I think we get a little more nuanced about it, which is what you're trying to unpack to be investment ready, let's say, right? To be ready for external capital from a fund or even from an individual angel investor is two variables here, time and growth. Right, that you want to have a view that says I'm going to grow really fast in a short amount of time, so I can get to $1 million in revenue in 1 year, 2 years, whatever it is, right? Some time period, and then I'm going to get to 5 within another compressed time period. Because great businesses can be built over time, or you can build a $10 million business over 10 years, and you can make tons of money, and you can employ people, and you can do a lot of things, right? But the return profile that a fund is going to look for is related to how fast you can grow to a certain threshold of value creation. And that value creation may be, an exit, right? Someone wants to buy you because you've achieved some level of momentum. It could be to the next funding round, right? To continue the growth of that business, right? I'm going to go and I'm going to raise a $500,000 Series Seed round. That's going to run me for 12 months. At the end of that, I'm going to have these milestones. I'll be at $1 million in revenue. I'll have 50 customers, and I'm going to be in a position to go raise a Series A round at a higher price. So a lot in that answer, Jim, I know, but that's kind of how we look at it. And I'm not a let me rip apart your pro forma type investor. I think at this stage of investing, the earliest stages, you can really get into a lot of wasted cycles on your assumptions and your variables. And in year 5, you say you're going to spend $42,952 on events. Tell me about that. Like, I think there's 2 variables when you begin to build your pro formas, right? There's your revenue assumptions and there's your cost assumptions. And any of you that have interfaced with me about this, I'm always looking at the $1 million milestone, kind of the $3 to $5 million milestone, and a 10. And I want to know, as revenue scales, what happens to costs? So, like, if you have to have 25,000 customers to have $1 million in revenue, and it's transaction revenue, which means those 25,000 customers have to keep buying every day, every month, every quarter, whatever it is. Like, what is your marketing budget? What does your customer support staff look like? Like, those are sort of the nuances of this. So, and I'm going to be quiet. Time and growth, I think, are important dimensions to think about when you forecast your business forward, versus just sort of looking at a bunch of pitch decks and saying, yeah, I'm going to go from 1 million to 5 million to 25 million in year 3. It can happen, but I think you got to be a little more granular in terms of how you understand the business can grow. So that's my answer.
I think at the stage that we're investing, seed stage investing, a lot of what we're looking for is, do you have the ability to build a pro forma that makes some sense in terms of how the business is going to operate, and that you have a plan. So when we see a hockey stick, we get nervous. But if we can see what you're planning for, and also a raise and taking outside money should be according to some sort of a plan or framework, right? So we see, a couple hundred businesses a year, and we've said this quite a bit, but there are a lot of great businesses there, but they're not necessarily investable. So that notion of understanding, are you building a lifestyle business or a small business where you can employ people over a period of time, be civically engaged, be involved in your community, and have a great business? Or are you actually growing to scale in a way that would return to investors, is something that is good to understand as early as you can. And so one of the questions that we often ask as part of our review process is, what is the use of these funds? So it's like, well, I'm going to raise $500,000, or I'm going to raise $2 million. Why are you raising that much, and why now? And I think that the exercise of the pro forma really helps from a business design standpoint, if you will, to say, this is where we are, this is where we're going, this is how much time it's going to take, this is how much it's going to cost. And even if that changes, if it's in the realm of reality, then it helps us to know that you understand, at least at the initial phases, your business and where you want to head. And again, I think the problem with this is the challenge is that in order to be considered to be investable, you have to show some growth. And so people get enthusiastic about that, because that's the reward, is, seemingly, is that if you show this great growth, then you're going to get this investment. But I tend to, and I think we tend to sort of say, is this a realistic view of what could happen based on a lot of what we've seen over the years?
Yeah, man. Sort of a good, I guess, kind of follow up to that. Another question's come in here, is around best strategy for an Oregon startup getting investment from Bay Area or Seattle funds. And I guess I'll parse that a little bit with just sort of fundraising broadly. And different markets look, I guess, for different things. But as the entrepreneur, I think that there's a couple things you got to think about, right? Which is if you've decided that you need to take external capital, right, to achieve your objective, and you believe that the market opportunity is time compressed, back to time, right? Or the capacity that you're going to need or the resources you're going to need to achieve significant operating milestones require external capital, right? So that's the first mindset. And I think that there's the way that we look at things. And then on the whole, I think this model would be applicable. It's basically where people's risk tolerance is. So when we engage with the company and we're like, okay, yeah, well, this is what we need to do to lean in. We need 3 boxes checked, right? Can you build the thing you think you can build? Which means a product is actually built, right? You will find investors that, hey, I'm three people that came out of Facebook, Slack, and Uber, and we're smart people because we have all these credentials and have built all this stuff in the past, and they can attract capital. We are not that kind of investor, but there are sort of concept, talent, pre-seed stage investors. And so again, this is just with respect to sales, right? Which is sort of pre-qualifying your audience. So again, first box that we want to have checked: can you build the thing you think you can build? Doesn't have to be total featured out, doesn't have to be the most durable product on the planet, but you've actually moved this beyond design, aspiration, and concept. Second box that we have to have checked is, does anybody care? Which means it's left the nest. And people beyond your friends and your family and the people that don't want to hurt your feelings or the bandwagon crew has gotten their hands on this and has given you very direct, often negative feedback around a lot of your assumptions, right? Pilots and trials and usage, data-driven things. Hey, you know, we put this out there. We've got 10 users. They spend on average 6 hours a day in this thing. You may be onto something versus I can't even get people to provision an account. Man, maybe got some things to do, right? So can you build the thing you think you can build? Does anybody care? And the third box that we really like to have checked is, does anybody care enough to pay? And again, this is just our frame of reference as an investor. And again, different investors have different views on this, because the pay part of this is not necessarily to say we're risk averse and you have to have plenty of revenue so our money's not used to fund the business. It's like, look, there's a lot of assumptions that go into basically having someone take $1 out of their pocket and hand it to you, especially if it's an indirect model where you're going to do some type of transactional thing or there's a volume-based model. So we like to have those 2 things checked, right? So I think that's a reasonable frame of reference, but I have some ownership of it. In different markets, we'll view different progress along those steps, right? Also, if you're an idea and you're 3 smart people, the value of your business is going to be less. So your investor is going to take more of it with an investment round, right? You're going to have to sell more of your business at that stage versus if you begin to mitigate some of these technical and market risk steps, you can actually demand a little more of a premium in terms of pricing because you've de-risked the business a little bit. So that's not a direct answer to the question geographically, but that's my opening salvo. So over to you, Julie.
Yeah, I think so. Interestingly, you know, we see a lot of our seed stage companies being funded more out of Oregon and Seattle. When it gets to Series A, there are it seems like more options for people. So it turns out, and I think that there are a lot of reasons for this, but it turns out that it can be difficult to have a business here and go to particularly the Bay Area for your first round of funding. And I think it's because it's a different environment. It's a different kind of overarching investment thesis. And, you know, we've been seeing over the last few years more seed stage investment funding available in the Pacific Northwest. And so it is in part this whole thing that Robert talked about building your network and not starting from scratch. Like having a business that you're just starting and trying to shop it in the Bay Area is, I think, really difficult unless you've got an established network that's taking you there. And you know, that's just a function of finding the people that are going to be supportive of your enterprise. But that's what we've seen a lot of companies when they get to Series A, and we have one of the things that we've done for a lot of our investments is when they get to that point, you know, we have a network of other funds that we refer people to so that they can, find the right partner for that Series A investment, which typically comes down the line a little bit further.
Yeah, good points. And in a kind of a follow-on point to that, which actually kind of goes back to the point on or the question on hockey sticks and such things, is that as an entrepreneur and as you're raising money, the size of the fund matters a lot to their interest in you, depending on what you're trying to do as a business. And what I mean by that is, so our current fund's about $6 million in size. It's a good size fund, right? But what we're judged on is our ability to not only return that amount of money, but a multiple on that. And so there's math involved in terms of the types of outcomes we're looking for that can generate that return. That math is different if we were a $600 million fund or $400 million fund, 200, whatever it is, like Benchmark Capital just raised a 400 and something million dollar fund, right? 425, something like that. Well, that's looking for, they're going to come in, they want to have 10 to 25% of the company, right? In order to return that fund and begin to make profits, you have to produce $1 billion outcome scenario. And that's the lens you'll be looked at with that kind of fund. And so as you think about raising money, an individual angel investor who's going to write you a $25,000 check, who is basically, they're their own capital, right? They certainly want that capital returned and they want a multiple up on top of that, right? But the 2x on that money is different than the 2x on trying to have a pooled capital fund come in, take a percentage of ownership, and they've got a bunch of other investments. And so you have to pencil out, if I'm a $100 million fund, right, I got to pencil out a $500 million exit scenario for you. And that's where you begin to get a lot of, wait, are your projections just aren't aggressive enough? It's not big enough. It's not scalable enough. Again, I've had this experience on the fundraising side when I started the company, and I wasn't thinking as big as I needed to. I was like, yeah, we could build some value here. We could sell this thing for a pretty good amount of money. And I sat down with a friend who was a partner in a big venture capital fund, several $100 million fund. And he's like, look, the category you're in has already had 2 IPOs. I'm like, yeah, but there's other opportunity here. Well, not for that fund in that segment, right? And so that's an investor obstacle, not necessarily an entrepreneur one, but it causes friction all the time. Whereas, like, you don't believe in me, you don't get it. There's a lot of just math related to the return on the money that's being invested in you that doesn't get a lot of airtime. Which, as I was out raising money, I didn't know that, right? I hadn't segmented the world to say this type of investor invests this dollar amount, this type of fund invests this type of money. If I'm really going to go for it and I want to be the next, Uber, I should go talk to a $500 million fund. So that's all just around pre-qualification of that. So just a long corollary, I guess, to the answer.
Well, and if we talk a little bit more about what we do too, our companies that we invest in typically have less than $1 million in revenue, and their valuation is typically south of 10 million, typically south of 8 million, and we're investing around $250,000 in those companies, and so to do what's called return the fund. We need exits in order to return that 6 million, and then whatever the multiple is. So you're right. Like, I always think about it in terms of it's more zeros. More zeros are required, to return a larger fund. And I think that is, in part, we wanted to build a fund that was right for seed stage investing in Oregon. And that's part of our thesis, is that if we invest $250,000 in a company that has a valuation that's less than 8 million, we get a fairly good percentage. We can be we could be an active but not activist investor, and then those exits don't have to be 100x in order to return monies to our investors.
Mm-hmm. But we certainly will take those.
Yeah, we will take
as would our investors. Yeah. So that in itself is probably a whole chapter of this thing to get to kind of talk through, and again, not something that gets a tremendous amount of airplay, and is often misunderstood by the entrepreneur, right? You think you're being judged in terms of the validity of your business, and more times than not, it's around fit to the quantitative model that drives the fund that's looking to you. And it just doesn't always get the airtime it needs to.
Yeah, I think we've both been there in terms of raising money too, to have many, many, many. I know I have many no's before I get a
That's
yes.
right. That's right. That's the source of energy is the no. Um, so I'm gonna. This is a question that came in, which is the what's your latest impression of impact of the pandemic on seed investing, size, best 2020 timing, target verticals. So I'm gonna go one step up from that, and we'll come back to this. But because Julie, you're so wise, I'm gonna hit you with the will this get better? Oh, sorry, will this get worse before it gets better? And that's on multiple levels, right? We're on our own psychology of being stuck in our homes and our children and everything else, right? But economics, right? Public health. Just your thoughts on that, and that nothing that's gonna cause you to be on the front page of a newspaper. Let's hope.
Yeah, or on my political soapbox. Um, yeah, so this is, I think, a very interesting question, and where I would go with it is prepare for the worst and expect the best. So the reason I think that way is because the alternative is not great, right? One of the things that we've been looking at is that right now Oregon has done some easing of the guidelines around stay at home, trying to open up. Certain counties have opened up certain industries in certain counties. And, it's an interesting question. So my thinking on this, and this is really my opinion, is that if we're able to, keep the numbers of people that are suffering down, then we can begin to move into a phase where it's not quite so intensely scary for small businesses and startups and everyone kind of across the board. But if there's a big spike, then we're going to experience more constraint, and I think that's going to cause economic issues. So in terms of the companies that we're seeing right now, we're not seeing a lot of new companies. We're not seeing a ton of companies, starting up that are getting traction right away, things like that. But we are seeing companies that have traction, that are that, in our view, are making the necessary adjustments. And we've really been focusing quite a bit on the cash management piece of this. So can you traverse the chasm if there are spikes in this? Can you traverse that chasm for 6 to 12 months with cash in order to come out the other side? And Robert, you said this really well in terms of kind of a survival mode right now, and then move to more of a sustaining model, and then more of a thriving model in 2021. But I think it's going to take some time, and I think from a philosophical standpoint that we have to exercise control over the things that we can, and there's some things that are not in our control. So from a public health standpoint, in my view, there are guidelines that if people pay attention to them and do the mitigation strategies that we each can individually do, that's going to make a huge impact. The weird thing about this, and I think that this is contrary to how people think, is if we do these mitigation strategies, then nothing happens. So then it seems like we didn't really need to do it because nothing happened, but it's because we did this that nothing happened. And I think that the more that we can do those kinds of functions, and then press down hard on being as innovative as possible, asking for help from people that have been through other economic downturns, managing cash, maybe looking out over the ledge a little bit to how we can adjust sales models and income, revenue models. All of those things are part of this systemic approach that I think we have to take. It isn't like one industry failed or something that's causing, the level of unemployment that we had. This is a really systemic problem, and it requires systemic thinking. So we have to think about all the knobs and levers that we can each turn to make a difference in kind of global well-being, and then all the things that we can do on an economic basis to get our companies ginned up to really be productive as things open up more. That
Yeah,
was a lot of
excellent
different
points.
things. I'm reading all the time, and I'm trying to weave it all together myself at this point.
Yeah, no doubt, right? I mean, I think that's it. I think there are so many unknowns, right? This is played out over such an amount of time, and back to kind of the question on seed investing and kind of how we're looking at it, areas of opportunity or not. I mean, the balance of the year is going to be a grind. Um, you know, good and bad. There's so many folks that have been displaced, right? There's so much damage that's happened in such a short amount of time to the economy. Uh, um, the noise and the nonsense, right? There's a lot of aggressive steps that have been taken to try to backstop that. Not perfect by any means, right? But the social net and the fiscal net and the stimulative piece. I mean, there's a lot of things that have been tried to come to bear. And I think that this is a tough time to kind of go out and travel around and secure new customers, right? That's just a difficult thing. And I think that back to kind of especially if you're early stage, and I'll put this on a B2B lens, right? If you're like going to solve a problem for a company and it happens to be in the billing area, right? The area that maybe you thought the most signal was coming in, or the biggest gap or the biggest problem may have changed, right? It may now be the fact that this is because there is, an unknown around churn, right? Or a newly distributed workforce. This is a recurring thing. Newly distributed workforce creates all sorts of problems. Like anywhere that there's an on-premise legacy system that a company has to, manage and maintain, you got to be inside the building to access. Massive opportunity, right? To take that and go attack that from something that's related to the cloud or something like that. So I think there's time in this stage for these kinds of conversations, even if there's this giant cloud of unknowns, right? There are things that are beginning to materialize. And then there's this also larger sort of, hey, it's great, everybody's going to work from home from now on. And, I live in, San Francisco, and I'm going to move to Boise or Bend or somewhere like that, and I'll make the same salary. Well, the thing about a distributed remote workforce is that your competition is no longer just everybody in San Francisco. It's kind of everybody on the planet. And so that'll be interesting as it relates to sort of talent and the ability of companies to accelerate, right? But also the impact, right, to folks that that maybe had a certain compensation level based on where they were physically located. It's kind of an interesting angle that I read a little bit of an article about. So it's all kind of swirling around in there, right? There's people, there's sort of people changes, there are process changes, there are technology changes. There's this mass damage being done to physical retail and this mass uplift happening to e-commerce. Okay, well, so that's the direct-to-consumer model, but like what happens to physical retail and what happens to the wholesale channel? I mean, there's a bunch of things around in there. So if anything, what's happened is focus is going to be much more important. But if you've had a set of assumptions about your business, this is a pretty good time. You can probably go out and have a lot of good conversations. You may just not get a lot of purchase decisions.
Yeah, and that's what we're seeing a lot of. And I think it's important, when there's constraint like this, it's really good to look for gaps. Right, this is where innovation comes from. Innovation comes from disruption. It comes from things kind of breaking down, and there are a lot of things that are breaking down. So where are the opportunities in that? And I can't remember if we used this example last week, but we have a company that in our portfolio that does event management software, and suddenly, like one day there were physical events, and then the next day there weren't. And so they put together this whole global virtual event that is being launched. It's a multi-day event. It will have event professionals from all over the world, and they're basically sharing best practices for how now to produce virtual events and help companies still have that need, and in some ways more need to get together and collaborate. And so how do you do that effectively on a virtual basis? We have another company that, one day they had a huge revenue stream, and the next day it essentially got down to a trickle. And so they basically beefed up some of the solutions in their effort to engage clients in a different way. And so it's like, where are the gaps and where are the possibilities? And if there is no possibility, then how do you manage your cash and your people for the maximum amount of well-being over a period of time? And again, you know, this whole thing about prepare for the worst and expect the best, I think being an entrepreneur is super hard because there's not much between you and your success or failure, right? And so these outside influences that are outside of our control, it's like what things can we actually adjust to make a difference?
Yeah, understood. Questions? Yeah, no, we've got a good one here. It's got a lot of layers to it. So from Mark, so I'll try to address some of these, and then we can certainly play it out a little bit here. But basically says we're in the middle of a seed raise. Approximately a third of the funding is raised in the bank. What are your thoughts on message to current investors and to other potential investors? So let's start with that one. I think, you know, it would, you know, the fact that that you're attracting capital, I think, you know, it attracts other investors, right? I mean, we're not afraid to be a first check. There's a lot of investors that kind of need that signal. It's like, okay, somebody else is invested in this, so therefore I will. So the fact that you're down the road, I think, is an important piece, right? It certainly shows this is investable. I think that, you know, if it's a third of the way to, you know, $1 million, and that's $300,000, and you're getting a more headwind, right, in terms of people being wishy-washy, or hey, we're going to step back, or, you know, we're not going to do anything until later in the year. You know, that may just be a recalibration of your plan, and think about what you could actually achieve with a third of the capital raise, and just, you know, close the funding round now, and with the goal that, you know, that when you go back out, you'd be at a higher price because you would have done some additional things there. You know, we have continued to invest through this process. We are working to close an investment probably today. We did another one about 15 days ago. We did another one about, you know, 45 days ago or so. So those were well in process with us as this intensified. You know, we always are interested in talking to great, smart entrepreneurs. And so we've got a lot of great conversations going on. We still very much plan to do what we've done in years past, which is we'll do an open application period, do an announcement about that and send that out to everybody as well. You know, that's probably going to land early, kind of early Q3 to sort of bring some net conversations in. So we're not only continuing to talk to folks, right, we're actually investing. And I think that's an important thing as you go and you talk to investors, which is, are you sitting on your checkbook until next year, right? Or are you actually still interested in investing? So that's my answer to the first part of that. Julie, I don't know if you've got some thoughts on that as well.
Well, one of the things that we did recently, and this may apply in the situation, I don't know, but we wanted to invest in a company, but we were concerned that if we just put our check in and they didn't have other investors step up, that they would not have enough cash. And so they would burn through our $250K and then not have enough to kind of make it over the hump. And so we said, we'll invest our $250K, but you need to raise an additional $250K. And I think it was helpful to the company that they had our commitment to go out and talk to other investors. And so I don't know where your investors are in that, or if you're stalled. There may be.
Yeah, that's a good point, right? And that structure was not designed to torture the entrepreneur, right? Or to say, hey, we'll do it, but you got to do this. It was more back to kind of that's the macro environment on this, which is we're going to look at your burn rate and we're going to look at your plan. And we, at this stage, what has changed is a little more comfort that you'll be able to get through Q2, right? And that you'll be able to navigate your way through the end of the year. So that may be a thing to kind of think about as well as you talk to your investors. Again, you've already attracted capital. You've got something cooking already that is interesting to people. Then it's about maybe how much timeline that buys you, because what would suck, right, is to pull that money in and then 60 days from now you got to go back out, right, and try to do it again, because fundraising is an immersive experience for the entrepreneur. We do our best to try to make it as frictionless as possible. We respect the fact that entrepreneurs have a ton more to spend their time on other than talking to us, but we are responsible for other people's money, and so we have a process, and we have to go into levels of diligence, and that does take some time. But I think those are some things to kind of think about, right? Which is this time investment versus the plan versus the business, and kind of where you are on that. So I think that was the first part of your question, Mark. So let me take the second one. And I'm not sure I quite understand this. How do you look at putting seed investing in management team during this stand down period? I don't quite, if you can elaborate on what that means, that would be great. You can do it in the comments over here. What ultimately would cause any seed fund to pull the trigger in today's environment? I kind of went through, our model. And, again, we start with a filter which says that we are Oregon first, but Pacific Northwest interested. So we have a geographic constraint, right? So we have investments in Seattle. We'll look in places like Boise. So we start with geographic constraint, and then we come down and we invest in software and technology and consumer products. And consumer products is primarily around direct-to-consumer businesses. Okay, so it's the next filter, right? And then we're going to say, and there has to be certain parameters on the stage of the business, the amount of money that's been raised, the price, right? This is the valuation relative to our check size. And then we kind of get into, let's start with our 3 boxes, right? Can you build it? Does anybody care? Does anybody care enough to pay? So all those things have to begin to line up. And then we get into, match and alignment with what we're trying to do, how it works for us. There's a lot of things that sometimes you can have all those things fall into place, and you can really like to do, you really like a team and a business. And there can be something structurally off. And what structurally off means the way the business was formed, the way the intellectual property is owned. I mean, these are just things that matter, not so much, they certainly matter now, right? But they matter more when there's a liquidity event, both for you as the founder as well as for the investors. If you don't, if there's a dispute on the core underlying intellectual property of the business, like that can kill an investment.
Same thing with founder complications, like there can be multiple founders, and there's history with founders, or complexities in terms of how those relationships have gone, and those aren't kind of clearly defined or clearly concluded. That can raise.
All right. So thanks, Mark, for the clarification here. So the speed of investing mid-seed. Yeah, I think that I don't know if this will directly answer the question or not, right? But fundraising is sales, right? And when you sell, you build a pipeline, right? You have prospects. Those prospects turn into leads. Those leads can turn into opportunities. Then your goal is to get an opportunity to convert to a customer. And it's a lot the same, in a fundraising process. If you've got one investor, right, you have a very thin pipeline. And so, what you have, and much in a sales model here, right, you have trust validation. You have third parties that have said, yes, you're good to do business with. You've got people that have already invested in you. And much like you would use a customer reference, right, to get a new customer, you can certainly use something that they're comfortable with it, right? An investor reference, right, for net new investors. Those carry a tremendous amount of weight, especially people, not advisor. I mean, there's value to anybody who's bought in, right, and that's surrounding a company, but someone who's actually written a check is a big vote of confidence. And so be very proactive about trying to align those folks. So I think the size of the pipeline matters. I think making sure everybody that's qualified in there. I mean, a lot of times what can happen in sales pipelines is that, hey, I've got a $2 million pipeline, and there's one deal in there of $1.5 million that's been in there for 16 months, right? It's this giant whale. And so the whole prospects of the business rest on that closing, right? That's high risk, versus having a more diversified kind of sales pipeline and portfolio. And we talked about this on one of the previous sessions as well, which is like your job, one is to minimize your time as the entrepreneur of how much time you have to spend on fundraising, but it is immersive because as the CEO, that's who people want to talk to. That's who investors want to talk to. But you do your best to remove as much friction as possible in that process. And that's back to, what do you invest in? Do you invest in my stage? Are you currently investing? What does it take? Right? I think that's a good question to ask anybody who you talk to. We try to be pretty clear, right, around what the hurdles are. And if we don't move forward, we try to be very specific about why. And as we talked about before, some of those are our problems, not the entrepreneur's problem, right? Value, the price, right? The opportunity. I mean, there's a lot of those things that kind of come into it. versus there sort of being some, giant wisdom that Julie and I passed down from the mountaintop on the validity of your business. This is never a question of that, right? It's always a question of our ability to have our fund invest for the success model that we need. So I don't know if that helped or not, Mark. All right, good questions coming through. Again, as we've done a couple of these, we've pulled forward some as well. So that's what I've got on my kind of handy dandy papers over here. I don't know if we talked about this one or not. I think we talked a little bit about this one last week, but it continues to be a theme, which is around, hey, this is a great time to start a business.
Yeah.
Like, what does that mean? Like, when people say that, what does that mean?
Well, I mean, I think it means a whole bunch of things, but one of the things it means is everything's all in, up in the air anyway. So why not start a business?
Right.
But on a serious level, I think, I mean, if somebody has had a job and they're laid off or furloughed, and they have had this idea for years, it's like, well, why don't I try it now? Because I didn't expect to be in this position. I think there's available talent. So I think there's a little bit more fluidity because people are available in a different way. I think when things, I mean, not that I've been through a pandemic before, but when things like a pandemic or, some huge cultural change event happens, like when we went through 9/11, people think differently about what they want to pursue. And maybe they've been stuck in a situation where, they've been grinding it out for years and just are like, well, I'm going to take the risk now. Mm-hmm. But I do think that things like this point out where there are challenges that need to be met with different solutions, right? It's kind of like, I've been on the phone on Zoom with my family so much. And, it's like, why didn't we think of that before? We're just doing just calling each other. And now this has completely changed things, right? So I think there's opportunity. Where there's challenges, there's opportunity.
Yeah, for sure. So I'll totally date myself here. I'm gonna go in the Wayback Machine to the .com implosion. Long time ago, and it was also a time when the cloud did not provide computing power. You actually had to buy servers, and you had a data room in your office. So I was part of a startup that completely vaporized during that time. We were really good at raising money, and that's about it. But we had a lot of hardware, and out of that destruction, right? It's sort of the creative destruction process, right? It was a great time to go buy hardware. Yeah. There was a lot available, and people were selling it for pennies. Yeah. Right. So that was, not quite the case now. You're not going to, get your virtual AWS, whatever it is from there. But like, it's a really good time to go sublease office space.
Yeah.
If there's, go ahead.
No, I think there are a lot of things like that to watch for.
Yeah.
And yeah.
Yeah, and I think the talent thing's a big thing as well, right? Good people and smart people, and are always busy. And if all of a sudden something cataclysmic happens and they're not busy, they're available, and they're either available to pursue things that maybe they wanted to pursue that they hadn't had the opportunity. Now, out of necessity, they want to, or they're available because now they're looking for something to do. Yeah. And it won't cost you as much as it would in a market that has 3% unemployment, especially in the technology sector where particular skills are in high demand. You may be able to get, essentially a better deal on talent at this stage as well. So, yeah, I mean, again, that's a little bit of the glass is kind of really half empty as we're sort of, and then it's like, look, here's all the reasons it's half full. Problems still exist. Companies are still going to need solutions. Like consumers, still have certain things that they're interested in or maybe will be interested in. I mean, the difference between now and the .com thing is, right, we're all carrying around little mobile supercomputers.
Well, this on the other piece of this, I think, one of the things Robert and I are aligned on in terms of people who found companies and companies that we invest in is we like this combination of humility and tenacity. And when there's a lot of money around and everything's, kind of humming along, I think sometimes people think they're smarter than they are. And so this kind of situation it's humbling to go through and to try and figure out what the solutions are. And for people that are entrepreneurs, it's sort of like once an entrepreneur, always an entrepreneur. We're gonna be tinkering around. We're gonna be looking for opportunities. We're gonna figure out ways to get through this. And the other thing is that people don't talk a lot about in entrepreneurialism is the notion of failure. So it is actually okay to stop doing something if it's not working, and that we don't have a lot of cultural support for, because it's like we need to drive forward and do these things. And sometimes you in this kind of situation you have to assess if it makes sense to stop.
Yeah, right. Excellent point. And again, this doesn't get a lot of airtime, right? Not every entrepreneurial venture succeeds, right? And I think it's important to finish well, right? Regardless of what that finish is.
Yeah.
Even if you're not going to return capital, even if it's not, I mean, it's how you manage that out, and it's how you take care of your people. It's the transparency you provide to your team so that they're not, you don't show up. This was back to the .com era where like people would show up to work and the doors would be locked, right? I mean, you run yourself that poorly out of cash. This is all about, back to this, it's about runway, right? I mean, the CEO founder's, job in the business is to set the vision of the business, right? Recruit and hire talent and not run out of cash. And so, if one of those is not going to work, right, especially the cash one, which is kind of the lifeblood of the whole thing, it's important to do that. And the other part of this, back to availability and such as, like, this is all opportunity cost. And when we, talk to entrepreneurs and get into the screening kind of call process. If you've been through it, we do a quick phone call, and then if that works well, then we kind of do a more formal prezo. And then we can kind of, if all those gates work, we progress. It's like, I'd love to ask, why are you working on this? Because you could be working on something else. Like, there's an opportunity cost to continuing to work on something that may not succeed, right? There's an opportunity cost to working on this project versus another project. And so you've got talent, right, as an individual, and you're applying it in a certain area. And I think unpacking like that, as it relates to assessing an investment, I think is super important. But also your own gut check on where your business is or what you're trying to do. And if it's not progressing the way that you want it to, or you're not feeling the success in the right way, is to be a little selfish, which is, this is opportunity cost, because I'm working on this. And if I wasn't working on this, I could be working on something else. So what are those something else's that may actually be a better utilization of your time?
Well, and Robert, we've talked about this, but I think most successful entrepreneurs that I know have had multiple failures and, situations that they were in where the company just completely vaporized, and some in a strong kind of good ending, and some where it didn't work out as well. And fund managers aren't often looked at as entrepreneurs, but one time somebody said to me, "Why are you working so hard on Cascade Angels?" And I said, "Well, it's either going to work or I'm going to expire. I'm going to be dead." And I don't actually suggest that approach, but for me, that's just kind of how I've always worked. It's like, I'm going to figure out a way to make this work. And I had plans and pro formas and a vision and all of that for how to build Cascade Angels, and then as it evolved with you in a Cascade Seed Fund, but it involved a lot of twists and turns. And I just think that this particular event with the pandemic, it was so quick. It was really unexpected, and I think it threw a lot of people into shock in terms of what to do. And now we're all sort of adjusting. And so it's like, what can we do? What can we do now to take care of our businesses, to take care of our teams, to take care of ourselves?
Mm-hmm. Yeah, a question came in around the Ben Venture Conference and what's going on with that. We don't know. It's not our event. Edco sort of runs that, and I guess we'll make a determination. And I think the step back on that is around kind of broader physical events, physical gatherings. And I don't know that there's a known there. right? I mean, they're trying to figure out if they can have baseball again, right? They're trying to figure out if college football season, professional football season is going to happen, and in the headline world we live in, right? I didn't read it, so that's my full transparency statement. But Cambridge University is going to online classes, to summer of next year, versus other universities are planning to start in the fall. So I don't know, and so I think that there's the will the physical gatherings be done, and then I think the next step is, will people be comfortable doing that, right? And then the other thing that's happened, again, this is all, we're all sort of stuck in our homes, and we come and spend time like this, right, on things like this, which is, you didn't have to fly anywhere for this, you didn't have to drive anywhere for this, right? You didn't have to pay anything for this. And so, the level of participation that you can get to participate in an event, I've got something later today that's, it's an hour with something on the East Coast. Well, I've got the time, I've got the inclination. I never would get on a plane and go there for this type of thing, but I can sort of experience that, or I can attend that. And again, that's all kind of like maybe a little bit of the sea change here. We've had online events for a long time. On the whole, large scale ones have sucked. But this is driving this need for something that's a little more collaborative, right? Or a little more, hey, let's do a main session, and then we can do in breakout sessions, and how people move between breakout sessions. I thought the Seattle Angel Conference that just happened did a really nice job of this. I don't remember exactly the platform they were using, but it was like main stage, and then it was like, okay, here's all the companies, and if you're interested, here's the virtual places they are, right? So you could go and you could kind of, does not substitute for human interaction, but it really allows you to get a lot of sort of the process in motion, right, leading up to that eventual sort of physical or physical proximity again. That was the other thing. Then I'm going to be quiet. Somebody said that yesterday. I was listening to. It's no longer about social distancing. It's about physical distancing.
Yeah.
Right. So we're not trying to shut the walls down around everybody. We're just going to be a little more aware of where people are in proximity to ourselves. Strange times.
Yeah, definitely. Are there more questions, or are we? I think we're good, right?
Yeah, we got a couple minutes here. We're about at the end of our time. Again, hope this was valuable and entertaining, somewhat entertaining. We'll do jokes next time. Impressions, Julie, do you have any good impressions that you can do?
No, not at this time.
It's surprising we don't rehearse these. No, we appreciate the questions. We appreciate everybody joining us. You got a lot going on these days. This is our opinions, not designed to be guidance or advice, tax, legal, or otherwise. And enjoy doing this. And if you got follow-up questions, please ping us. And we will do one of these again next week, which will be the 4th installment of the Ask Us Anything series.
Yeah, and I think just one closing thought here, small businesses and startups have been hit really hard. It's also the case that small businesses and startups will likely lead us out of this in terms of innovation, revenue, changes in the way that we do things. And that's a pretty exciting thing to be part of. It's like coming up, it's like going through the stages of grief around this, and getting like just really shocked. And then like, what do we do? And panicked, a little bit. And then it's like, okay, so let's get down to work. And when you say it's going to be a grind, Robert, I really agree with you. And so I think that kind of knowing that this is a marathon, not a sprint. And, I don't mean to just say a bunch of platitudes, but that is actually true.
We're just going to take it one day at a time.
You got to pace it. One day at a time.
It was a real team effort. I'm a big Bull Durham fan. I don't know if anybody's seen that movie or seen that movie recently. There's this awesome scene in there around, you got to learn your cliches and you watch it. It's how people that don't really want to provide any detail, they'll just, take it one day at a time, take it one game at a time. There's a real team effort out there. Anyway. Right. Yeah. Will, right on. Best baseball movie ever. There's a lot of life lessons in Bull Durham. So since you got some time at home, put it on the rotation.
Oh my gosh, you guys. Okay. Thanks for spending time with us. Great to talk with you, Robert.
Good to talk to you as well.
We'll see you next week.
Okay. Thanks, everyone.
Bye.